All right, crude oil prices are tracking toward their fourth straight week of gains on the back of further signs of tightening supply. How will supply deficit risk? How will that hit you as consumers? Here to discuss this and more is Pavel Molchanov, Raymond James Managing Director. Good morning to you. And so we were just talking about this inflation report from Michigan Sentiment. Inflation expectations high, and I would argue that's because of the move we have seen in oil prices and, of course, gas prices. How long do you think this will continue?
Well, the fact that OPEC responded to the year-to-date weakness in oil by cutting supply, as you noted 2 weeks ago, was actually a very timely reminder that supply-side risks have not gone away. For close to 100 days, oil prices were falling because of all the macroeconomic demand headwinds that we are familiar with: monetary policy, inflation issues, corporate layoffs, and so on. So along comes OPEC, cuts supply. Prices have jumped, but keep in mind, they're only back to where they were at the beginning of January. So it's not, it's certainly nowhere near the level of prices we had last summer when oil peaked at $120 a barrel. And we are still way off from that level. $80 to $90 is a manageable price. It's not that different from where prices were, if we go back to pre-COVID in 2019.
What does this mean in terms of the number of heat waves that we're also expecting this summer?
Well, heat waves are not going to directly move oil prices, but they are very relevant for natural gas. Mm-hmm. And let's, take a step back. Europe in particular experienced an epic energy crisis last summer. Obviously, in the context of Russia's war in Ukraine, the Kremlin has been and continues to weaponize the supply of natural gas, cutting it off to the European market as a deliberate political strategy. Now, that strategy has failed in a political sense, but it certainly explains why Europe continues to have the world's most expensive natural gas. Ironically, this winter, which was very warm, Europe's energy crisis subsided. But we need to watch carefully what happens this coming summer when the heat waves will return. Last summer, Europe had the worst drought in 500 years, which disrupted, for example, hydropower and even nuclear. Any rerun of that would bring back the energy crisis.
Pavel, in this environment where oil prices are on the rise, gas prices are on the rise, are there certain companies within the oil industry that might show outsized profits compared to others?
Well, the entire petroleum, oil and gas value chain is obviously benefiting from higher commodity prices. So for the producers, E&P companies, they are just swimming in cash flow. They're also, by the way, much more capital disciplined than they used to be 10, 20 years ago. E&P companies are no longer reinvesting every dollar they bring in. They are giving back a lot more in the form of dividends and share buyback, which shareholders love. Helps explain why these stocks have actually been very resilient, even during corrections in the oil market. At the same time, pipelines and drillers are benefiting from the fact that capital spending is increasing. Again, not as much of a capital spending increase as what we would have expected a decade ago. But again, the entire food chain is benefiting from very healthy fundamentals in oil.
As it's becoming more clear that an energy, or at least a clean energy transition, is going to take longer than expected, or at least hoped for as well, for humanity's sake. At the end of the day, for investors who have a long-term time horizon, what should they be keeping tabs on with regard to where that transition also impacts some of these oil companies that they may hold in their portfolio?
Well, look, it's pretty clear that fossil fuel demand will not grow forever. Uh, Coal is already on its way out. It's just a matter of how quickly. In the U.S., for example, coal used to be 50% of electricity. Now it's barely 20%. Europe's even less than that. Global oil demand will eventually peak. We do not think it has peaked yet. It'll probably closer to the end of this decade when that peaks. Of course, electric vehicles are helping to speed up that process, but oil demand still has some room to grow. And then probably natural gas has even more room to grow because, of course, that's a cleaner fuel than either oil or coal. But all of the fastest growing energy sources are renewable, solar, wind, bioenergy, green hydrogen. This is where so much of the incremental energy demand will be coming from. Oil companies know this. This is not a secret. And in fact, particularly in Europe, 1/3 of the capital spending by the big oils is already clean, low carbon, sustainable energy sources. The US, Saudi Arabia, we're not nearly as advanced in energy transition as Europe is. But if you talk to the US based big oils, they're well aware of this megatrend. They are on the energy transition bandwagon, just not to the same degree as the European players.
Pavel Molchanov, Raymond James, Managing Director. Good to see you. Have a good weekend. Shifting now to some commentary out